Aim is Creative Solutions, our concepts, your clients. Each month, we'll focus on stories of your clients spanning through various generations. We'll explore plans for your professionals starting on their careers, newlyweds and growing families, small business owners, and soon to be retirees. We'll show you how we carefully crafted risk management strategies to help your clients enjoy life in the moment. This month, we'll focus on long-term care insurance since November is Long-Term Care Insurance Awareness Month. Each month's series will last about 15 minutes, and you must be logged on the full 50 minutes to receive CFP credit. And since timing is everything, please ask questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's webinar is being recorded and will be posted to our website within a week, just in case you missed it. And throughout 2017, loyal fans will receive 9 CFP CE credits, 1 for each month. Today's presenter began working at LLIS in 1998. Since then, she's become LLIS's go-to person for connecting your clients with long-term care insurance and variable insurance solutions that meet their needs. And now, Jill McNeil.
Thank you, Taylor. Thank you all for joining us today for our November webinar. As Taylor mentioned, November is National Long-Term Care Awareness Month, so it's only appropriate that we talk about long-term care this month. And November, we also think of Thanksgiving, and hopefully after you watch this presentation, your clients will give thanks for having you as their advisor, and you can help them prepare for the future and the chance that they may need long-term care. So today, we're going to talk about several things. First, we're going to look at some facts and figures for the chance that your clients may need long-term care and the cost of that care. We're going to look at funding, 4 different options that people usually consider when thinking they can fund long-term care. We're going to concentrate on women and how important it is for them to plan for the future. We're going to look at the consequences if your clients wait to purchase or to plan for the future. And we'll finish up by looking at some underwriting and some case studies that recently happened in our office. There's a 70% chance of needing care over age 65 for Americans. And 20% of those people needing care will need care for at least 5 years or more. And how does that break down between males and females? Well, women on average need about 3.7 years of care. For males, 2.2 years. What usually happens is the husband or the male becomes sick, the female takes care of him, he passes away, and then when she's older and needs help, there's nobody there, she's by herself. So very important for your clients to understand this. $253 is the national median rate for nursing home care, and that's the national median rate. So depending on where your clients live, it could be much higher than that. If they're in New England, California, Alaska, it's much higher. If they're in a rural area like Oklahoma or Texas, it could be lower. So when planning for your clients, keep that in mind, and if you want some help on that, I'd be happy to give you the cost of care around the country. 68% lifetime probability of needing assistance with 2 activities of daily living or being cognitively impaired for Americans. Those numbers are important because those are the 2 triggers for qualifying for care if you have a long-term care policy. Over 8.3 million people receive paid long-term care services per year in the U.S. And when I say paid, that's meaning in a nursing home, assisted living facility, home health care provided by a certified nurse. That's a pretty big number, but look at this number. Over 65 million people receive informal care from family members or friends. And I think that number is probably a lot higher than that. It's hard to record that. But again, that's a lot of care being provided by family members, friends, and neighbors. In 2012, 5.9 million people over age 85. That number is expected to increase to 19.4 million by 2050. And over 30% of that age population have severe to moderate cognitive impairment. So those people are going to need a lot of care. How is Medicaid going to handle all that in the future? So I think it's, again, very important to plan for this. And how much does care cost? Let's break it down a little more. Assisted living facility, about $45,000 per year. Those were 2017. These are 2017 numbers. Home health aid based on 40 hours of care per week, over $49,000. And then a private room in a nursing home, 97,455. So your female clients, if remember we saw they need about 3.7 years of care, that's over $360,000 of care for 3 years of care, and that's today's number. So, and since 2012, the last 5 years, the assisted living, home health aid costs have risen every year by 3%. Nursing homes have 4%, so it's steadily going up. Recently, Lincoln Financial did a survey, an online survey, and they asked the people about long-term care and other financial matters, and 58% of the people responded saying they have been caregivers or know someone that's cared for a loved one. But yet only 41% of the clients have discussed this with their financial planners. When you meet with your clients and you start to talk about long-term care, you introduce it, you're probably going to meet with some resistance. You know, some of the typical responses: "It's never going to happen to me. I'd rather take a gun to my head first. I'll go out in the backyard." Kind of gruesome answer, but I've actually heard that several times. They say it with a smile on their face, but how serious are they? "I don't want to talk about it right now." It's not a nice conversation to have. It's kind of like talking about life insurance. You don't want to face these death or needing long-term care. But it's important to talk to your clients about this. And when you talk to many of your clients and give them the facts and figures, they're probably going to open up and be happy to talk about it and plan for the future. But those clients that still don't want to discuss it, maybe try a different approach with them. Talk to them about the consequence to their family. If they become sick, it's not only going to impact them, but it's also going to impact their family greatly. Especially appeal to them, especially your male clients who have probably spent their lifetime, or the last several years of their lifetime, being the providers for their family, taking care of the family, providing the income. So talk to them, help them to understand the impact of if they become sick. And there's about 3 major impacts on a family. The spouse may become ill from providing care. If you have a husband and wife in your office talking to them about long-term care, and the husband says, "Well, if I become sick, my wife will take care of me." Look at the wife and ask her, when's the last time she picked up her 250-pound husband? How often does she want to do that to take care of him? And their children will be impacted. Their children may have to put aside their life to provide care for mom or dad. Their children will have to put aside many things that they'd rather be doing, more time spent with their own family, or maybe their jobs or their careers will suffer as they need to take time to take care of mom and dad. And providing care may divide family members. At a time when somebody's sick, you want the family to be united together, not to be divided as they argue about who's going to take care of mom and dad. So appeal to your clients about the whole impact on the family. And most of the time, the caregiving does fall on the shoulders of the women in the family. 75% of caregivers are women. The average caregiver is a 46-year-old female who spends approximately 20 hours per week caring for her mother. So think about this. At 46, she probably has her own kids still in her home with her, and so she has to split her time taking care of her children and her own mother, and she probably has a full-time job that she's trying to keep also. So that's a lot of stress to add on to your daughter. And these caregivers are 2.5 times more likely to end in poverty. And they're 5 times more likely to depend on Social Security. So again, appeal to your male clients that if they want to take care of the important women in their life, help them plan for the future, so it doesn't fall on the female's shoulders. Now let's talk about funding long-term care. There's 4 ways that people usually think about funding long-term care: Medicare, Medicaid, self-fund, or purchasing a long-term care policy in some form. Now let's talk about Medicare a little bit. Medicare is health insurance. It really pays for skilled and rehabilitative care. It's not designed to pay for custodial care, which is what long-term care insurance really is. But it will pay for care in certain circumstances. It'll pay for 100 days in a skilled nursing facility if the patient has spent 3 nights in a hospital stay and enters a skilled nursing facility within 30 days of that stay. Medicare will pay for the first 20 days 100%. Days 21 to 100, the copay will be required. But in order for Medicare to pay for this, the care must be rehabilitative care with ascertainable goals. So what I mean by that is, let's say your client maybe falls and breaks a hip, and they have hip replacement, and they need some rehabilitative care because the doctor's pretty sure that that person or that patient's going to be able to return to a normal lifestyle. So Medicare may cover that. But again, only the first 100 days. For an example, if your client maybe falls and it's been determined that she has cognitive issues, maybe Alzheimer's or Parkinson's or dementia, I'm sorry, and they're probably never ever going to get better, then Medicare probably will not pay for that coverage. Okay. Oh, sorry about that. Covered all these. So again, you need to have rehabilitative care with ascertainable goals. Now, Medicaid eligibility. We all know Medicaid is for the underprivileged or those that probably can't afford to pay for their care. In order to qualify for care, you really have to spend your assets down. It varies by state, but basically 2,000 is the number that assets have to be spent down for. Monthly income cannot be more than $2,163. The community spouse can hold on to about half of the couple's assets, up to $119,000, and they can hold on to the shared home. So if the spouse is still living in the home, that they can hold on to it. I have read recently, even if there's a prenup agreement, those assets can still be used or gone after by Medicaid. And do you really want your clients to rely on Medicaid? These are two pictures that were in the news fairly recently when I was preparing for this webinar. The one on the left, these are ladies sitting in a Medicaid facility in Texas after Hurricane Harvey. They're waiting to be rescued. The one on the right is another Medicaid facility, and this is Hollywood, Florida. This is after Hurricane Harvey. After this facility lost power, and you probably already know about this, 12 people lost their lives because they couldn't have the power on and run the air conditioning. So again, do you really want your clients to be reliant on Medicaid? And with Medicaid, your clients probably will eventually would receive benefits, or being taken care of, but you lose control when you have to rely on Medicaid. You lose control of where and how the care will be received. If you go to a Medicaid facility, you may have to move far away or a ways from family and friends. Now, self-funding, this is a good option for a lot of your clients. And your clients may have assets or the capital is self-fund. But the purpose of capital is to generate income during retirement. So every dollar spent on care takes away a dollar that can be used to generate income. So every capital dollar used to pay for care is one less dollar available to generate income. And if they have to use the capital to fund care, there's several consequences to doing this. Liquidity. The assets may need to be sold at a loss, not a good time to sell it. Or taxes. Liquidating qualified assets can create unnecessary taxes. Legacy assets. Maybe family property has to be sold, family farm, or even if it's a vacation home, maybe a family cottage or a ski property that the family all enjoy using, the grandchildren enjoy using. If that would have to be sold off to pay for mom or dad's care, that would be sad. Maybe your clients are charitable minded, and if they have to use their capital to pay for their care, they would no longer be able to leave a charitable bequest to their favorite charity. Now let's look about consequence if your clients do buy a long-term care policy and they plan for the future. By having a long-term care policy, it protects the family by providing a predictable stream of income. So they don't have to sell off assets to get that income. They have right away, if mom or dad becomes sick, there's a form of payment right there, and at time of need, it's nice to know that. And by having a long-term care policy in force, the family can hire professionals to provide that care. They don't have to be the care providers. They can just manage the care. Many times having that long-term care policy will allow the insured to remain in their home. And the long-term care policies will also pay to have the home modified, maybe put in a wheelchair ramp or special bars or handles in the shower so that mom or dad can stay at home. And again, the long-term care policy will pay for those modifications. And having the policy in force, less stress for the family, because as I said, immediate stream of income, immediate place to go turn to. And the family can continue on with their lives and remain intact. When they visit mom and dad, they can visit with them. They don't have to be the ones providing the care. And when you have a long-term care policy, there's an instant support staff. So again, if mom or dad becomes sick and they have a long-term care policy, the long-term care policy may provide a care coordinator. So this care coordinator can come out to the insured's home and help them come up with a plan of care. It can sit down with the insured and the family members to determine what type of care is needed. Do they need home health care? Do they want to go into assisted living facility or maybe into a nursing home? And this care coordinator can discuss the policy and go through the policy and help them understand what benefits they have in the policy. They may have bought this policy 20 years ago, 25 years ago, and can't even remember what the benefits they have. And if they have an inflation rider on the policy, it's probably grown and they don't really understand how big their benefit is at this point. And also the care provider can provide a list of, the care coordinator can provide a list of care providers. She can provide a list of home health aides, can provide assisted living or nursing home approved facilities that the insurance company has worked with in the past. So again, just having this long-term care policy is a place to turn instead of having to go on the internet and try and find care providers for family members. Many times I get to ask this question: who should purchase long-term care? Who are good candidates? What of my clients are good candidates? Well, we kind of came up with this rule of thumb. If your clients have assets under $500,000, they probably can't afford the long-term care premiums. Again, they'll probably receive care, eventually have to rely on Medicaid. But your clients that have over $3 million in assets, they can self-insure. And even these clients may want to consider purchasing a hybrid policy. By purchasing a hybrid policy, they're going to put their money to better use. They would have bigger long-term care benefits than if they just set aside a nest egg to use it. And we're going to talk about the hybrids a little further on. So the rule of thumb, if your clients have assets between $500,000 and $3 million, they may be good candidates for a long-term care policy. Now let's talk about women and care and how it's important for them to plan. Women need to plan because women live 5 years longer than men on average. 80% of women are single at death. Nursing home residents, 3 times the number of them are females versus males. And 2/3 of long-term care claims are for women. Now, I'm just going to answer a question that I had come in asking if we're going to be sharing a PDF of the presentation. If you go to our next week, if you go to our website, you'll be able to see the presentation on our website. You can see it all there. Okay? And now going back to our presentation, we're going to use Tammy as our example of a female client and how important it is for Tammy to look at options for her care in the future. We're going to say Tammy is 56. She lives in Atlanta, Georgia. She's divorced and has 2 daughters. So Tammy doesn't want those 2 daughters to be her caregivers. She wants to free up their time for them and plan for the future. So Tammy went to her financial advisor, and they came to us looking for options for Tammy. First off, we'd start out looking at cost of care in her area. So in Atlanta, the price for a private room in a nursing home is $6,965. That's the median price for care. But at LLIS, we use an 80% number or 80% rule. So that number of $6,965 includes the cost of food and other essentials that she's going to have to budget for anyway. Tammy's going to have to budget for those anyway. So about 80% of that number is what it's going to cost her out of pocket for the nursing home. So we recommend she consider a long-term care benefit of $5,600. We'd recommend a 4-year benefit period for her. Remember earlier we looked at the average stay for women is 3.7 years. We recommend a 3% compound inflation rider. So this means that her benefit will grow by 3% every year, because it may not be until 20 or 30 years until Tammy needs that benefit. So we want the benefit to increase over time. And we saw earlier how inflation, how much prices are increasing. Many companies still offer 5% compound inflation, but it's become very expensive. Some companies still offer 3%. I'm sorry, some companies still offer 4%, but most of the policies we sell nowadays have 3%. Okay, now let's look at choices for Tammy. So several choices nowadays for policies for long-term care. There's traditional long-term care, which is just straight long-term care. She could look at a hybrid life policy, which is a life insurance policy with a long-term care rider. Or we can look at a hybrid annuity. So 3 choices here. So traditional long-term care policy is just a straight long-term care policy. It's designed to provide custodial care. In these policies, we have a choice of benefit periods from 2 to 6 years. Benefit amounts. Benefits are usually range now from $50 up to $400 a day, benefit amounts. Elimination periods, 30 days up to 365 days. Those eliminations periods that are available vary by company and by state. Inflation riders, as I mentioned earlier, we can still add inflation riders onto the policies. 3, 4, 5% are the most common inflation riders, and there are other still various riders we can add onto the policies. Companies have eliminated a lot of riders over the last couple of years, but we still have some basic riders, some return of premiums, some 0-day elimination period riders, so we still have a choice of some riders. The only option nowadays on premiums for traditional long-term care is lifetime premiums. We can no longer do the single premiums or the short pay premiums. Premiums are not guaranteed on these policies. Premiums can never be increased on an individual basis. The only way the premiums can be increased is if the insurance company goes to the state and asks for a rate increase for a whole group of policyholders, and they have to show justification for that rate increase. Oh, and okay, premiums not guaranteed. Okay, and for Tammy, we looked at 3 long-term care policies for Tammy. These are the 3 companies that we are still using for long-term care. 3 good companies, good financially sound companies with good basic policies. And for Tammy, as I said, we wanted the $5,600 monthly benefit, and we can get that with all 3 companies. We're looking for the 4-year benefit period, again, available all these companies. 3% compound inflation. No return of premium on these policies. So no option to add a return of premium. Some of the companies do have return of premium, but it's very limited. Most of them you have to have the policy in force for 10 years and then return of premium on what they pay to it. So not a very good option, and it's very expensive. No death benefit on these policies. Again, these are just straight long-term care policies. And the form of long-term care payment on all these policies is reimbursement. So if they have a policy, they go on claim, they have to pay for the care out of their pocket, then they submit the bills to the insurance company reimburses them up to their daily or their monthly benefit. Used to be we could get indemnity policies, but those are no longer available. And these are the premiums for Tammy for the policy. So in this case, we'd probably choose Mass Mutual. And the reason Mass Mutual is coming out the lowest for Tammy is basically because they are still using unisex rates. Most of the other companies have now gone to gender-specific rates. As we saw, women usually go on claim for longer than the males. So several years ago, the companies went to using gender-specific rates, with their rates much higher for females. But Mass Mutual still has unisex rates. So if you have any female clients that are looking to buy traditional long-term care, they may want to act fairly quickly. We're not sure how much longer Mass Mutual will still offer the unisex rates. Now let's look at a hybrid life policy for Tammy. So a hybrid life, let's review what a hybrid life policy is. It's a life insurance policy with a long-term care rider. So it's a life insurance chassis with a long-term care rider. With this policy, you're going to get several guarantees. These are good policies for your clients that want to guarantee they're going to get something for their money. They're guaranteed they're going to get a death benefit or a long-term care benefit, and they're guaranteed their premiums are going to stay as projected. They're not going to have rate increases, and many of them have a return of premium. And there's several different funding options with these hybrid life policies. You could do a level pay, meaning lifetime premium payments, or you could do a single premium. If they have a lump sum and they want to do that, sort of pay it and forget it, we can do this, we can do that. Or a 10 pay or less, meaning you pay premiums for 10 years and have a totally paid up policy, or maybe 5 years or 3 years. And we can also do 1035 exchanges into these policies. If they have an existing life insurance policy, we can roll it into one of these policies. If they have existing annuity, we could roll it into the hybrid life. And within these hybrid lives, we can break it down even further. We have what we call our traditional hybrid life, and we have what we call our supercharged. So not to confuse matters, but just want to break it down even more. So under the traditional hybrid life, the focus is really on the death benefit. So your clients that want a higher death benefit, we probably might want to go with one of these type policies because the death benefit is higher. The long-term care benefits typically is 2% of the death benefit. So again, if you know what death benefit that your client wants, then we know that what their long-term care benefit is going to be, because the long-term care monthly benefit is 2% of the death benefit. With these policies, again, you're going to get guarantees. You're going to get a guaranteed death benefit, long-term care benefit, and guaranteed premiums. And when I say guaranteed death benefit, when they pass away, if there's any death benefit left, because long-term care benefits they receive reduce the death benefit dollar for dollar. So let's look at one of these traditional hybrid life policies for Tammy. These are the 3 companies we ran quotes for, 3 good companies again. These had the best options for Tammy. So with all 3, we were able to get the $5,600 monthly benefit that she's looking for. And the death benefit is $280,000. Remember, I said the long-term care benefit, monthly benefit is 2% of the death benefit. So that means she'd have a $280,000 death benefit with all these companies. The benefit period is 50 months because the $5,600 subtracted from the $280,000 long-term care benefit will last for 50 months. 50 months. No options to change that. So no flexibility there compared to the traditional long-term care where we had flexibility in the benefit period. Inflation rider, cannot add inflation rider onto these policies. So once the long-term care benefit is set, that's where it remains for the lifetime of the policy. Return of premium, pretty much not, they don't really offer a return of premium. On the American General, it does have this kind of strange return of premium where in years 20 and 25, they have the choice to get 100%, or Tammy would have the choice to get 100% return of premium, but only in those 2 years. So generally with these policies, we don't have a return of premium. The formal long-term care payment on these policies is indemnity. So this is very nice. So once they go on claim, prove that they meet the triggers, the insurance company is going to send them a check for their long-term care benefit, the $5,600. So nice. No paperwork needs to be done every month. So these are all indemnity form. And I ran these for the lifetime premiums. Generally, with these policies, the only option is a lifetime premium. So premiums aren't that much higher than the traditional long-term care premiums that we looked at a few moments ago. In this case, we'd probably choose the American General because she lowest premium and also does have that return of premium. It's only in years 20 and 25, but it does give her some option here. And they're all pretty straightforward policies. At the end, we're going to compare all these different options for Tammy, so you might want to keep that American General policy in mind. Now let's switch and talk about the supercharged hybrid life long-term care policies. With these policies, the death benefit is minimized. So your clients that the death benefit is not the most important option probably don't want to go with these, because here we're going to maximize the long-term care benefit. We have options on long-term care benefit where it's not just a straight 2% of the death benefit. We have options on this, how we want to set it. And we can add an inflation rider onto these policies. Benefit periods, choices are 2 to 7 years. Again, we're not limited to just the 50 months like we are in the traditional hybrid. We have choices here for benefit periods. And we have short pay design. These are short pay design. So you can do single premium, 10-pay premium, pay up to age 65. Generally not, one company does have lifetime premiums, but most of them do not have the lifetime premiums. These are for clients that have a fair amount of cash and they can afford the short pay premium design. Now let's look at these policies for Tammy. Again, we chose these 3 companies because they have good financials and a good solid supercharged policy for Tammy. And with all 3, again, we can get that monthly benefit that we're looking for. We can have the choice. The first 2, we can get that 4-year benefit period for long-term care. Pacific Life, we have to go to the 5-year, so a little bit longer, but it is there. Death benefit, $134,000, so almost half of the death benefit as compared to those traditional hybrid life. We can add an inflation rider, so very nice that you can add an inflation rider. Lincoln, this is their Money Guard policy, excuse me, have the option to add on the 3% compound like we were looking at and the traditional long-term care. The other 2, the Minnesota Life and Pac Life, no option for the 3% compound. They did have 5% simple and 3% simple. So I chose with 5% simple because it's the closest to the 3% compound inflation. Options for return of premium. Lincoln Financial, you have a choice of 80% or 100%. Most of the time, we go with 80% because it gives the insured the highest long-term care benefit for the lowest premium. But you do have a choice, 80% or 100%. The Minnesota Life, 100% return of premium after 6 years. Pac Life, 100% right away. So nice return of premiums. The long-term care payments on these are indemnity form of, again, you have a choice. Minnesota Life, indemnity, which is very nice. Lincoln, reimbursement. With Pac Life, they have a choice of indemnity or reimbursement, and I believe the choice has to be made when they start to receive the payments. On all 3 of these, I went with the lump sum premium to compare apples to apples. So these are single premiums. You see Minnesota Life, $112,000. Lincoln is just a little higher, $113,000, and then Pac Life, $130,000. So you see on the supercharged hybrid life, a lot of choices. You can design it very similar to a traditional long-term care policy. In this case, if we were probably going to recommend a policy for Tammy, probably go with that Minnesota Life, lower premium, indemnity policy. Again, the indemnity is nice versus the reimbursement. The indemnity, you don't have to submit the bills every month. Now let's look at a hybrid annuity for Tammy. So the hybrid annuity is a fixed deferred annuity with a long-term care rider. So it's a basic annuity. If she needs long-term care benefits during her lifetime, the annuity would pay her long-term care benefits. The only option for payment on these annuities is a single premium of non-qualified money. So can't use qualified money for these. It has to be a single premium of non-qualified money. Get several guarantees with these hybrid annuities. You get a guaranteed monthly long-term care benefit, and you get a guaranteed pool of benefits. You have a choice for the long-term care. You can go with 60 months or 138 months. So 2 choices there. No option to add an inflation rider with these policies. You cannot add an inflation rider. So again, compared, very similar to the traditional hybrid life policy, once long-term care monthly benefit is set, it stays there. Actually, the monthly long-term care with the hybrid annuity grows a little bit as the annuity value grows, but it's not going to grow as quickly as if you added a 3% compound inflation rider onto the policy. And with these hybrid annuities, very minimal underwriting on these. There is underwriting, but it's very limited. So this is very nice. So these policies are good for your clients that may not qualify for traditional long-term care or the hybrid life. We've had several occasions when clients applied for traditional long-term care and they could not qualify in the underwriting, so they were happy to go ahead and apply with the hybrid annuity, and we were able to get them coverage with the hybrid annuity. Another nice thing on these policies is you can add, you can make them joint. So if your clients have, maybe you have a husband and wife and one of them has a life insurance policy with some cash value, you could roll it into one of these hybrid annuities and get coverage for both of them. Even though it's on the one insured, you can still add the second, the spouse on as a joint annuitant and get coverage for both of them so they can both be on claim. In this example here, we're just talking about Tammy just to keep it simple, but there are several options if you have couples. But today we're just going to keep it simple and talk about options for an individual. Now, if Tammy purchases hybrid annuity, how would it look after 1 year? Her monthly benefit would have grown to $5,600, $5,651. Benefit period for her went with 5 years. Inflation rider, as I said, no option to add an inflation rider on this. Premium, single lump sum, $134,400. So again, only option is a lump sum on these hybrid annuities. After 1 year, she'd have a surrender value of $122,940. Not get all their money back, but very close. The form of long-term care payment is reimbursement. Now let's compare all 4 of these products for Tammy. If she purchased all 4 of these policies at age 86, if she went on claim, how would these policies have stacked up, or how would they have grown, and how would they provide her with benefits at age 86, and what would she have paid for them? So for the traditional long-term care, if Tammy paid premiums for 30 years and went on claim, she would have paid $106,000. That's assuming that she had no rate increases. So those premiums are not guaranteed. We don't know if she's going to have any rate increases over time. Chances are she probably will. The insurance companies have made a lot of changes to their products over the last several years in hopes that we won't have the rate increases, but we don't know for sure. On the traditional life with the long-term care, she would have paid $115,000. Again, that's lifetime premiums on that policy, and those premiums are guaranteed. So we do know that that's the amount of premium she would have paid. The supercharged, that was a single premium that we went with, so that again is guaranteed, $112,000. A hybrid annuity, $134,000. Now, how have the long-term care benefits grown? On that traditional long-term care policy and the supercharged hybrid life, those have the highest long-term care benefits, or long-term care pools. Death benefit, the traditional long-term care has no death benefit. The traditional hybrid life has the highest death benefit. The other two do have some death benefit. Return of premium, no return of premium on the traditional long-term care. The other 3 options have some return of premium. So which policy is the best in which circumstances? Well, if Tammy purchased that traditional long-term care and she went on claim, that's probably the most advantageous for that policy. With the traditional life, hybrid life, if she dies and hasn't used any long-term care benefits, she's going to have a death benefit of $280,000. That policy has the highest death benefit. With that supercharged hybrid life, it's kind of a win-win situation. If she goes on long-term care claim, she's got a large long-term care pool. If she passes away, her beneficiaries would receive the death benefit. Or if she decides to surrender the policy, she has a nice surrender. On the hybrid annuity, probably the most advantageous if she surrenders the policy, because this policy has the highest surrender value. So here you can see the options for Tammy with all 4 different policies. This is a chart that we made up here at LLIS to help you sort of determine what type of policy your clients may want. Many times we have advisors or clients come to us and they say that they want a life, they're not sure if they want traditional long-term care or if they want a hybrid, or maybe they just come to us because they've heard about the hybrid policies and don't know the advantages or don't know what options their clients have available on these hybrid policies. So we put this chart together to give you just a sort of snapshot of what the choices may be. So if your clients want a lump sum, then there's several choices. The hybrid annuity, the supercharged life, or the traditional life, those are options. If they need annual premiums or lifetime premiums, the only option here is that traditional hybrid life or traditional long-term care. If they want shared care, they have the traditional long-term care, the hybrid annuity, or the traditional hybrid life. No option for a shared care policy on that supercharged hybrid life. If your clients have an existing life insurance policy and they want a joint policy and they want to roll that, do a 1035 exchange and cover both of them, we can do this with a hybrid annuity. So that's very nice with that hybrid annuity. So this chart is on the LLIS website. You may want to use it. Again, it's a nice sort of summary of what options are available for your clients. I see a question here. It says, how does cash value in a life insurance policy get used when choosing one of the life insurance options? So if your clients have a life insurance policy with some cash value, we could roll it into any of these hybrid policies. Can't roll it into a traditional long-term care policy, but we could roll it into to fund one of these hybrid policies. Let's say they wanted to roll it into one of the traditional. They could roll it and then they'd still have to pay premiums going forward. Or you could roll it into the supercharged and maybe use what they have, and if it's enough to fund everything they want, the long-term care benefit, that would be it, no more premiums. Or you could roll a 1035, the cash value, into the supercharged, and then also pay additional premiums. You could pay additional lump sum premium, or you could pay additional premiums over 10 years. So you can do that, okay? Got some other questions coming in. I'll try to get to the rest of these questions at the end and see how time allows. So I'm going to continue on here. And let's talk about cost of waiting. If your clients decide to delay purchasing a policy, how will that impact them? Well, their health could change, making the client uninsurable. It's always best to apply for insurance, life insurance, long-term care, disability insurance when they're young and healthy, and better chance of applying, maybe even get preferred discount or preferred rates. And the premiums are based on age at time of purchase. So every year a client waits to purchase, the price increase, okay? So let's look at how it would impact Tammy if she decided to wait to purchase a policy. So if she again, we're looking at a policy for her of these benefits, $5,600, 90-day elimination, 3% compound, 4-year benefit. And here I'm just talking about traditional long-term care policy. So we saw at age 56, if she purchased a traditional policy, premium $3,537. If she waited 5 years, she'd have to purchase a policy with a larger benefit because, remember, it had the 3% compound inflation. So she'd have to purchase a policy with $6,303 benefit, and that premium $4,500. If she waits 10 years, that's what she'd have to purchase and the premium she'd have to pay. If she waited 15 years to purchase, she'd have a premium of roughly $11,989. And that's based on today's premiums. In 15 years, we don't know what the premium would be at that time. So that number, $11,989, is based on today's premium for a 71-year-old. So how does this all add up? So if she went on claim again at age 86, and if she purchased the policy now at age 56, she would have spent $106,110 on premiums. But if she waited to purchase that policy till age 71 and went on claim at age 86, she would have spent $179,835 on premiums. So pretty big increase. You can see that pile of these a lot higher at age 71. So again, encourage your clients to purchase the policy when they're looking at it when they're young and healthy. And what ages are people purchasing long-term care policies? Well, you can see not many people are buying them before age 44, age 44 to 54, 25%. But you can see most policies are purchased between the ages of 55 and 64. 55% of policies are purchased then. And that's kind of the sweet spot. The average issue age is age 55. So don't let your clients wait. You can still purchase your policies in your 70s, in your 60s, and even in your early 70s. But you're going to pay a lot more for premiums at that time. And also, again, they may not be insurable. Now let's talk about underwriting for long-term care. The underwriters are concerned about issues for morbidity, not mortality. They're not concerned if your clients have some issues that are going to make them uninsured, that are going to cause them to die prematurely. They're more concerned about if your clients have pre-existing conditions that are going to have them cause them to need assistance to be able to perform activities of daily living in the future. So if your clients have maybe your clients have multiple sclerosis, MS. If your clients have multiple sclerosis, they're not going to qualify for a long-term care. They would not even qualify for the hybrid annuity. If your clients have Parkinson's, any type of cognitive issues, they're not going to be insurable for long-term care. If they have COPD and are using oxygen, they're not going to qualify. So these just a snapshot of some conditions that would make your clients uninsurable. But there's many conditions that your clients probably think that they're uninsurable, such as cancer, or maybe your clients have had heart issues, heart attack, heart disease, or maybe they have arthritis and have bone-on-bone arthritis. Many times your clients are uninsurable if these health conditions have happened recently. But the good thing, over time, they may become insurable, because many pre-existing conditions are insurable after a period of time. So the underwriters will look at their condition and determine that over a period of time that they may be insurable. For cancer, if it's been early stage cancer and it's been a year or two since the last treatment, depending on the company, some companies only require a year waiting time, other companies require a 2-year wait, but after that waiting period, the client may be insurable. If they've had a heart attack and after a period of time they're fully recovered, there's been no permanent damage, their quality of life is good, then they may be insurable for long-term care. If your clients have arthritis, bone-on-bone arthritis, they've had a knee replacement, hip replacement, gone through physical therapy, most companies do require a 6-month wait, but then after that period of time, they would be insurable for long-term care. So that's the good thing. And if you have any questions, I'd be happy to help you. I can contact underwriters to see if your clients may be insurable. Quickly here, I'm going to go through some case studies that recently some actual cases that happened in our office fairly recently. Alan and Debbie. They came to us in March 2015 and wanted quotes for long-term care. For the benefits they wanted, their premium at that time, $3,804. In July in 2015, they decided to apply for coverage. They didn't apply back in March when they were first looking at quotes, and that's pretty typical. A lot of clients take their time looking at this and considering if they want coverage, which is fine. It's a big commitment, but as we looked at, it does cost a wait. It does can impact. In this case, when they decided to apply, and we did the interview with their case manager, realized that Debbie was having physical therapy due to spinal surgery. And at the time, she would be uninsurable. We would have to wait 6 months after she finished her physical therapy, and then she may be insurable. So they came back to us in April 2016. At this time, they wanted to apply. The 6-month wait period was over after finishing her PT. But when we got updated information from them, Alan and Debbie, realized Debbie was having issue with her hands or finger. She had surgery recommended. I was a little concerned. I didn't know if an underwriter would consider her now because of that pending surgery. Turns out it was just a minor surgery, and they would cover her for coverage at this time. Insurance would consider her for coverage. Turns out Alan was approved at select rates, and Debbie was approved at Class 1 rates. So the good news is Debbie was approved. Class 1 rates is the third underwriting class. It's higher premiums because it's the third underwriting class. So remember, originally we quoted them a total combined premium of $3,804. But now when they applied, premium was $5,459. So it did cost them. This is the impact of waiting, in their case, $1,600. Again, the good thing is we did get them coverage, but if they had applied back in 2014, we might have been able to get them coverage for a lot less. One more case study. Here's Linda and Larry. They came to us in January 2016 looking for quotes, and they applied, and we went through Linda was approved at preferred rates, so she got the preferred discount, a 10%, 15% discount. And Larry was postponed because it turns out he had degenerative disc disease and had upcoming treatment. He had a traction machine in his basement, which he was using. Larry didn't reveal any of this to us. So if he hadn't revealed it to us, we would have advised them to wait to apply, because we would have contacted the underwriter and we would have known the underwriter would not consider them for coverage. But the good news is they postponed Larry. They did not decline him, they postponed him. Linda went ahead and put her policy in force and still received a 15% discount because Linda and Larry had applied together. Linda still get a 15% spouse discount because she has a spouse living in her home with her. So October 2015, just last month, Larry was ready to apply again. So he finished treatment for the degenerative disc disease, no longer needs to use that traction machine in his basement, and he's ready to apply. So the big question is, did Linda want to apply with him again? The benefit for Linda applying again is if they apply together, they can get the full 30% spouse discount on each of their policies, and they can get the shared care rider. So originally they wanted that shared care rider. By adding a shared care rider onto their policies, it adds flexibility. It's like sharing, instead of them each having 3 years between each, adding the shared care rider, it makes it like 6 years to share between them. So we looked at all the different options. So Linda's current premium, remember she put her policy in force, was $3,086. If Larry applied now on his own, his premium, $2,162. So they'd each have their own policies. Their two premiums together, again, this is their combined premium, joint policies, but their two premiums, $5,248, individual policies. If they applied together and were approved, the premium for the shared care policy, $5,042. So Linda has decided to apply. So if she's going to keep her current policy, if for some reason she does not get approved at as good a rates as she currently has, or if Larry doesn't get approved, then Linda will just keep her current policy. But if Larry's approved, is applied for, and Linda again gets the preferred rates, they will get that shared care policy and save a little bit over $200 on their premium. So they are in underwriting right now. We don't know how it's going to turn out, but just wanted to give you an idea that even if your clients do get postponed, good idea for the other spouse to put their policy in force, and we can do circle back and go from there. Now we looked at all four, looked at needing care, or today we looked at funding, women need to plan, cost of waiting, and underwriting. Here's some tips for some caregivers that was recently in the Tampa paper. It's okay for a caregiver to ask for help, especially if it's a spouse and providing care. It's all right for them to get help, get some time off, have a break. And the caregiver should have a central location for information about the care recipient. Have a central, maybe a document on the computer that lists the doctor's names and addresses and information about the medication. So if another family member comes in or a friend comes in to take care of the patient, they have a central location to go to if they have any questions about the care. And a good idea to check, many employers nowadays have benefits for employees. They have, they're partnering with organizations that provide assistance, may even include access to social worker to discuss different options. So for your clients that work for bigger companies, they might want to check employee benefits. And again, it's okay for the care provider to take time off to get to refresh and get a break. Because in summary, it's better to have some long-term care in place that allows a loved one to care about you rather than being forced to care for you. So even if your clients can't afford the Cadillac of policies or they can't afford that supercharged hybrid policy, it's better to have some care in place rather than not having any care, any policies at all. Okay, I have a lot of questions here, so I'm going to look at it, see if I can answer any of these questions. I have got a question here. What about clients that have type 1 diabetes? Are they considered insurable? Yes, type 1 diabetes. Depending on their A1C, if their A1C is under control, and depending on how much insulin they take, one of the companies we work with will still consider type 1 diabetics. The hybrid annuity would be an option for a type 1 diabetic. Again, it depends on the control and how much insulin they use. Then another question, what is the process to determine the insurance health status? Well, if you're in question about your client's health status, you can give me a call or have the clients give me a call, and I'll be happy to go through their health history with them, and then I may be able to give them an answer right away, or I can contact the underwriters to determine if they may be insurable. If they apply for coverage, they're going to go through the underwriting. Medical records will be ordered for all the products. Long-term care does not require an exam. The hybrid life do require an exam, and again, it depends on the policy, what product they're looking for. And I'm sorry, we've run out of time. I will try to answer your questions by email, any ones that I have missed. And I'm not sure, I've had several people ask me if we're going to share as a PDF. I do know that the presentation will be on our website, and if you want to email me tomorrow, again, asking if I will get the answer about if we're going to share the PDF presentation. So again, send me an email, jillmcneil@LLIS.com, and I can get that answer for you. So in wrapping up, just the 10 things that makes LLIS different. Our free monthly webinars, as you listen to today. Thanks for joining us. These are the other 10 things. I want to skip to number 10 here is show you here. Number 7, we proudly sponsor these. We have our specialists. I want to skip to number 10. Hopefully, many of you are aware we just renewed our new portal called LLIS. This will give you access anytime, anywhere, 24/7 to your clients' information. You can see clients that have existing policies. You can see what they have in force. You can see who their beneficiaries are, when they're put in force, their death benefits, premium payments. So a nice access for you. Of course, we're always happy to answer any questions that you have on your client's coverage, but you may want to just go into LLIS and find out what they have. If you haven't sent this up, give us a call. We did send out postcards, and we've sent emails with an access for you to get online. And hopefully this will make life easier for you and your clients. And again, I'm sorry if I didn't get to your questions. Let's see. Oh, somebody asked me if I would show slide 29 again. Let me see if I can get to that pretty quickly. Bear with me. Sorry, probably a better way to do this, but in risk of, yeah, we're almost there. Okay, here, slide 29, the traditional hybrid life. These are the 3 companies we chose. I'm not sure if there was a specific question on this, but here is slide 29 for those that you wanted it. Somebody asked me at the end if this is my dog. Is this your pug, Jill? Nope, that's not mine. I have a little Shih Tzu. He's just as cute, though. But thank you again for joining. And if you have any questions, please send me an email, and I'll be happy to help you. Thank you all very much. Bye-bye.